First up, China's central bank has revealed its latest monetary policy tool. It's known as the Standing Lending Facility, or SLF for short. People's Bank of China launched the SLF already at the beginning of this year, but only now made the information public. The facility aims at providing large amounts of funding to banks when they face a liquidity squeeze and are unable to get sufficient financing from the interbank market. The SLF has a tenor of 1 to 3 months. It functions similar to the U.S. Federal Reserve's discount window facility. The PBOC says the SLF played an important role in easing China's liquidity squeeze among its banks back in June of this year, which caused the overnight interbank rate to surge by 30%. The total value of outstanding SLF have decreased 5% from June to September. The PBOC says this partly shows that liquidity has increased in the Chinese banking system. All right, now let's get a quick overview of the monetary policy tools used by China's central bank. So at present, now there are 5 instruments, including open market operations, a reserve requirement ratio, central bank lending, benchmark interest rates, and now, of course, the newly announced standing lending facility. Now, through an open market operation, a central bank buys or sells government bonds on the open market. It aims to move short-term interest rates and change the supply of base money in the system. The reserve requirement ratio, or the RRR as it's known, is most widely used by central banks across the world. It sets the minimum percentage of cash each commercial bank must hold as reserves rather than lending it out. The PBOC also directly lends its reserves to commercial banks when they face cash shortages. It also sets the minimum rate of return investors will accept for buying non-government securities. And finally, the Standing Lending Facility, which once again aims to provide large amounts of funding to banks when they face a liquidity squeeze.